What we have now is we have a structural deficit and nobody seems to be solving it. Are bond buyers really the force that they used to be? You know, given the fact that most of the debt is now being actually bought by the Federal Reserve, are the private market bond buyers a force?
Well, it is true that QE2, the Fed is effectively financed the Treasury's needs plus. So if it stops in June 30th, then it's got to depend on other bond buyers. Now, if there are no other bond buyers and they are backing away, like Bill Gross did by selling his $28 billion of Treasury securities, you will then also have major problems in the economy, and you won't make it to 2012 without a crisis. But assuming that if you, for example, the last budget that Barack Obama put out, which was right after the CBO budget, which comes out in January, they project 3.7% average debt to GDP annually for the next 10 years. Now, bond buyers wouldn't think that that's horrible. Okay, it's not like it is now, 10, 11%. Mm-hmm. So if that projection gets lifted, okay, from say 3.7 to 8, well then there will be no bond buyers, and logically speaking, because why would you be buying into what is going to be a major increase in the cumulative debt?
Right.
So those are the things that I think are subtle here. It's do we go into a double dip? Do we have outside forces that cause the double dip, whether we care about it or not, and we have no control?
But it looks like we are going into a double dip now, don't you?
It does.
Yeah. So
it does. 1.8% GDP with all the stimulus from the Fed and QE2 printing, effectively buying $900 billion worth of debt with the rollover.
yeah, it's like they put the foot on the pedal and they flooded the engine, and the engine just isn't, turning over.
Correct.
And it looks like a double dip is all but certain. I think this is what John Williams of shadowstats.com is also suggesting.
Right. Well, he is a great analyst of the real numbers. Yeah, a double dip looks highly likely, and just to put a reason on it, the Obama administration is doing everything it can to cause uncertainty to business people to start businesses and put capital up and take risk. And there's very little of it, I should say. Mm-hmm. So the fact is that with this uncertainty over tax increases, with the healthcare issue is still up in the air, what the budget deficit is going to be, the budget is going to be, if you will, all of these things make people hesitant. If you had $100 million in the bank, maybe you do, and if you do, if you had that though, why would you risk when you don't really know what's going on? See, those are the people that really, they are the ones that make the decisions, but their decisions are of growing businesses and starting businesses, but they're going to be influenced by what they think the future is going to be. I mean, they're not going to risk their money unless they think there's a pretty sure reward.
Yeah, and that's actually contributing to the weak economy. There just isn't the job growth that one would normally expect after coming through what we came through.
Exactly, especially with 30 months of zero interest rates.
Yeah.
30 months of zero. I mean, you have to go back pre-war to find that kind of scenario.
Which is actually quite interesting, because imagine what the federal deficit and debt would be now if we had normal interest rates. Because we're at $14 trillion debt. 1% on that is $140 billion additional deficit that the U.S. government would be incurring.
Correct.
And so 5% would be, let's say, a normal historical interest rate on government paper. T-bills now are 0.5%, if that.
No. T-bills are 3 basis points.
3 basis points.
As of this morning.
Yeah, so it's going to be a big impact in terms of the debt. So higher interest rates are actually a problem as well, because what that will do is cause more federal spending to pay off the interest expense, which will cause more federal borrowing. So they're
correct.
Really between a rock and a hard place.
In this case, the higher interest rates, again, I've done this study, so I might as well give you the free statistics of my research. In 2020, in 10 years, right now, the cumulative interest payments as a part of the total debt is 8%. If you use the CBO numbers, which they get from the Obama administration, in 10 years it'll be 21.5%, using their numbers. Now, where's the difference going to come from? And that assumes the Bush tax cuts go away. So they assume that taxes and total tax collections are going to be in the 20.5% range for the whole decade. And therefore, with that, it's still going to be 20.5%.
But that's unsustainable.
It is. It's 21.5%. You can't, in other words, you can't find the difference. So there is really, if you don't change in a major way, this is unsustainable. It doesn't work.
So even the Republicans' proposed budget really is not enough to bring about the change that's necessary?
Not if you assume a 4.7% average interest rate.
Yeah, and because they're also, I think, have some pretty rosy projections in terms of what they're talking about for economic growth, which raises some questions whether those are realistic as well. And
Correct.
they're not proposing to bring the deficit down until, I think it's 2027, if I'm not mistaken. So, I mean,
You'll never get there.
something will happen beforehand.
Well, that's, under these conditions, you're not going to get past 10 years because like I say, where are you going to get the other 14, the difference between 8 and let's call it 22, where are you going to get to 12%?
Yeah.
And that assumes the end of the Bush tax cuts, which is not a sure thing.
Yeah.